All right, let's continue from where we left off at the end of the first class of the 1st of March. So this essentially counts as your second class on the 1st of March. We have already covered all this. We've covered moneyness of options. We learned about intrinsic value, time value, and the relationship between, how would you express the option premium as a sum of IV and TV. Then we learned about ATM, ITM, OTM by defining them based on the relationship between the strike price and the current price of the underlying asset. Right, then we learned about option sensitivities when we looked at an option pricing model such as this one. We see that the model not only does it provide a theoretical price for the call option, and then through put call parity we have a price for the put option. It also gives you the option sensitivities, delta, gamma, vega, theta, rho. Alright, so we've already covered all this stuff. Now then we came into the, I'll just briefly explain here about if you see now what you see in this, say we said that this is actually an option pricing model. That's what the market refers to it as, but in fact actually it's an option valuation model and not a pricing model, because you don't really need a model to price the option. The market is doing that anyway through the interaction of demand and supply. The market is setting a price, so the pricing is being done. So this is actually bad nomenclature, but this is what the industry uses, so you have to get used to it. But in your mind you should know conceptually that what people in the market call an option pricing model is actually an option valuation model. It's a type of fair value model. Okay, now if you want to see, right now you can't see what we call the specification of the model. You can see that this model has these kinds of inputs: exercise price, days, interest rates, dividend yield, vol, etc., and underlying, etc., and these are the outputs, this one mainly and then this one. But you can't really see how the inputs lead to the output. If you want to see, that would be called the specification of the model. You can just go here and see it. So this is the solution to the Black-Scholes this is a solution to a partial differential equation. So this will give you essentially, in some sense, the specification of the model. This is really the solution for the call option and the put option values. But you can get some idea of the mathematics using some reasonably high level mathematics using certain theorems like Ito's lemma and those kinds of slightly advanced mathematics, which at this stage we don't need to bother with, because we are not really concerned with the pricing of the option, the theory behind the pricing or the valuation. We are concerned with how to apply what are the features of this product, that is the option, the instrument that we call option, call an option. The features of that product, we are interested in the applications of the product. We're not really interested in the pricing and the theory behind the pricing at this stage. That would be an advanced topic for research. Okay, so this is your option pricing, option valuation model, strictly speaking. We'll call it an OVM, and these are your outputs. Okay, so what we discussed is, we discussed this. Now we are interested in these terms: gamma, vega, and what is meant by short gamma, long gamma, etc. So one of the things you have to understand, when you're long options, you are said to be long gamma. When you're short options, it doesn't matter whether it's a call option or a put option. If you're short an option, you're supposed to be short gamma, and if you're long an option, you're long gamma. Essentially what this means is, if you are long, let's take the long side. Okay, if you're long an option, you're long gamma. What you're actually playing for is, you're playing for high volatility in the underlying price. Now here's your GDX price. Okay, so essentially you're looking for something where there's a lot of movement, there's a lot of up and down movement in the underlying asset price. So that's what you're playing for if you're long gamma. Okay, that is normally the understanding of what is meant by long gamma. If you're long gamma, you benefit from dramatic movement and an increase in the volatility of the stock, of the underlying asset. Vega is obviously the vol, the sensitivity to the vol input, and if you are long short options, you are said to be long short vega. So long options, essentially long gamma, long vega, and short options, short gamma, short vega. Now the other thing is, before we come to this, theta, we've already covered all this stuff. You've seen that both options, long positions in either a call or a put, will have a negative theta, because the option will keep on losing value every day. Okay, now the other part, the last part that we looked at, when I vol rises, option prices ceteris paribus will rise, I vol falls, then option price of ceteris paribus will fall. And what we discussed is we looked at the vol input here. And so essentially what we said, the last part we discussed in the previous session was that this is your option valuation model, and it need not necessarily correspond to the actual market price of the option. So let's look at an example. If we set up this as an example, and so we just take any, let's say we look at any option price. Here the call option is worth $3, and if you look at an option price which is worth, say, $6, then one of the things you can clearly see is if the option is actually, this is your OVM valuation model, which is giving you a theoretical price, which means this is the fair value. Remember, the theoretical price is conceptually the same as the fair value, okay, according to this fair value model. This model is saying that if these are your inputs, then the call option should be worth $3 roughly. Let's forget the decimals. But when you look at the market price for this option with these same parameters, you find that that option is worth about $6. So this means that your vol input is too low because the rest of the information is already known. So your vol input is too low. So let's change the vol to 45. So instead of saying that the one standard deviation move in the stock is likely to be 25, one standard deviation annual movement in the stock is likely to be 25. Let's just say that it's going to be 45. Okay, and let's see what happens to the call option price. Okay, so it's 5.3, still not taking us to 6. So this is how actually you figure out what implied I vol is. Okay, you can see the process of the determination of I vol. It is done exactly in the same way that you do IRR. You can't analytically solve for IRR. You have to iteratively approximate to the solution. Okay, so you put in 45 for your volatility input, and you still see that the call option price is 5.3 theoretical price, the fair value, but the market price is 6. So the question basically is, what should the vol input be to give you a fair value equal to the market price? So what you do is you keep on raising it. Let's make it like 48. No, still not working. Okay, so let's make it 52. Okay, so we're kind of there. Now if we make it like 51, it's a little bit over 6. Okay, so 5.98. So you get the picture, right? Okay, so if I don't know if this takes input. Yeah, so it's closer. It does take a little bit of this kind of input. So I'll make it 51.3. It will be, now it's getting closer to 6. So essentially what we can see by doing this kind of, this is exactly what you would do mathematically as well, because you cannot actually back out the solution for I vol. You have to do it in this iterative approximation method, exactly like what you do for IRR. You can't analytically solve for IRR. So by analytics, this is an important point to understand at this stage. I've used a couple of terms. Let's teach you that as well at this stage. We are discussing implied volatility, so let's discuss this. Okay, I vol is OVM, that is option valuation model. Okay, let's put it this way: the vol input in the OVM, which makes the OVM output, that is throughout output, a fair value, okay, which is FV, for the OPT, that is the option. Okay, so understand this. What is I vol? Mechanically speaking, I vol is the vol input in the OVM, which makes the OVM output. Okay, let's take it step by step so we are very clear. Mechanically, we are defining I vol. I vol is the vol input in the OVM, which is this, You can see what's happening here. You saw me putting in different values all the time. I was just changing the vol input figure, okay? The vol, and I was doing it in the OVM, okay? So it is that vol input in the OVM which makes the OVM output which makes the OVM, let me not put output here. Let's write it this way. Throw out a fair value for the option, okay? So that particular vol input in the OVM which makes the OVM throw out a fair value for the option. So the OVM is throwing out a fair value for the option for any value that you put in, because we are interested in a particular type of vol input, and that is that particular value for the vol input, like in this case 51.3, which makes the OVM throw out a fair value for the option that is exactly, it's a little redundant actually, exactly equal to the market price for the OPT. Okay, so this definition has three parts. So IVOL is a particular vol input in the OVM, okay, specific vol input in the OVM, which makes this OVM throw out a particular call option theoretical price or fair value, which is exactly equal to the market price for the option. This is what is determined by the interaction of buying and selling in the marketplace, okay? And so as such, it does not necessarily have to come refer to the OVM, but this is what IVOL essentially is, okay? So IVOL, and then from this we can actually learn something else, which is IVOL is a once again, I'm making you some of you might find it a little boring, I'm repeating the same stuff, but once again I'm making you go through this exercise to make your concepts 100% clear and the use of the language also 100% clear. IVOL is a species of vol input in an OVM. Remember, just like we said, refresh your memory, contract is a species of agreement. Whenever you write a sentence like that, what you remember is that because a contract is a species of agreement, all contracts are agreements, but all agreements in general will not be contracts, okay? So this is a smaller set, contracts, and this is the larger set. This is how you write the language. Contract is a species of agreement. And now what am I saying? I'm saying IVOL is a species of vol input in an OVM, okay? You've already seen this in action. What does it really mean? You saw me trying to enter various values for the vol input. I put in, first I put in I think 45, it was 25, first I put in 45, it didn't work, then I made it 48. And every time I was putting in a value for the vol input, it was actually generating an option price, which means the OVM was actually giving me an output, a fair value output. It's just that that was not equal to 6, and 6 is special because 6 is the market price. So I'm watching, on the one hand I see that the market price is 6, and I keep entering numerous figures into this vol input field, 45, 48, 50, and I keep getting fair value outputs from the OVM, but those fair value outputs are not equal to the market price of 6, okay? So there are many vol inputs that I put in, and only one of them turned out to be the IVOL, which is in this case 51.3 if we just ignore the decimals. Now that 51.3 IVOL vol input, I get a fair value for the option which is equal to the market price. So that's why you can see that, so IVOL is a species of vol input into an OVM, because whatever you input into an OVM is a vol input into the OVM. But every vol input is not an IVOL, because every vol input is not going to give you a theoretical fair value which is equal to the market price. Only one vol input is going to give you that result, and that is the one, whatever it happens to be, in this case it's 51.3, which produces a fair value equal to the market price, okay, which you see independently. So that's what I vol means mechanically. I vol is a species, that's why I say I vol is a species of vol input. Okay, obviously it is a vol input, but it's a special, all vol inputs will not be I vol, because all vol inputs are not going to produce a fair value equal to the market price. So let's define I vol once again. Okay, so I vol, okay, we've already done that here on top. Okay, so I vol, the definition of I vol is it's the vol input in the OVM which makes the OVM throw out a fair value for the option which is exactly equal to the option price. Okay, so you've learned this about the I vol. Now let's now quickly go on to some of the other stuff. So this might be a slightly short video because I just want to make sure that in this video I give you the framework necessary for trading options. So you've already learned about gamma and theta. What you have to remember, you'll have to memorize this in a sense, because over time as you read it, it'll automatically get memorized, that essentially long option positions, long gamma and negative theta. Okay, so what happens is in most option trading, especially when you're looking at it from a market maker point of view, there is this thing called the gamma theta trade-off. Okay, that is essentially if you are long options, you will benefit from dramatic movement like what was happening over here, dramatic up and down movement in the underlying asset price if you're long options. But every day that you're long options, you're losing money on the theta. Okay, you're losing money on the theta because every day every long position has negative theta, whether long call or long put. So this is the trade-off. It's just like what we showed you in that framework for the firm trying to balance trying to balance the need to earn money on the one hand and to stay solvent on the other hand. Well, in order to earn money, the firm has to we go back to your, okay, so this is what is meant by the trade-off. You understand trade-offs very well, I think. The trade-off between the pleasure of looking at WhatsApp in the class and the risk of getting caught and losing points. That's also a trade-off. Okay, so here you see a trade-off. Firm is facing a trade-off between growing earnings and trying to stay solvent. In order to grow earnings, you have to increase risk. To stay solvent, you have to reduce risk. Okay, so these are mutually contradictory, so that's why you have a trade-off. Okay, so this is the gamma theta trade-off, which market makers are very concerned with, because if you want to benefit from gamma, you have to be long options. But if you go long options, then you're losing money on theta. And on the other hand, if you go short options to go short gamma, there is a risk involved in that. But in return for that risk, you get compensated by picking up the theta which you benefit from when you're short options. Okay, so gamma theta trade-off as such at this point of time we are not very concerned with, because this is something that really concerns market makers. This becomes very important when you're hedging an options book. Okay, so at this point of time we are not going to spend too much time worrying about that, because our main concern is to equip you for your project in which you are not going to be allowed to do any underlying hedging in the underlying assets. So typically when a market maker is managing an option book, he will be doing a lot of hedging in the underlying asset, which you're not going to be allowed to do in your project. Okay, so therefore we move to a slightly different focus. Okay, we look at what I call the Vega Theta trade-off. This is what is more important for your project. Similar to the gamma theta trade-off, because remember Vega is the sensitivity of the option price to changes in the vol input. Okay, so if the I vol increases, it's a circular way of putting it, but let's say essentially the I vol increases so that the fair value keeps pace with the market price. If the I vol increases, how much will the call option price increase by? That is given to you by the Vega. So if you want to benefit, as you see that as you can see here, if you increase the vol input, the option price goes up, both calls and puts. So if you are long options, okay, essentially in a way we say it's long vol and long Vega. As you can see here it says a long option position is long Vega. Okay, which means you're set to you're set to benefit from increases in vol and increase in I vol essentially. Okay, so and I vol has a connection to H vol. So essentially what we are concerned in this project is, because here we are only going to be buying and selling options. So we want to come quickly to a quickly to a framework which will help us to trade. And let's look at this. So there is a Vega Theta trade-off that you guys are going to be facing in this project. Okay, you will want to buy options if you want to benefit from an increase in vol. But the problem of buying options, whether you buy calls or puts, is that now every day, see what happens in a long option position, the theta is negative. Okay, whether you're long calls or puts. Okay, this is actually showing you the long option position profile Greeks. Okay, so therefore, in order to benefit from the Vega, you want to be long options. But when you go long options, every day you're getting hit by the theta. So it's very delicate. And so there you have to get your timing exactly right, and that's the trade-off that you're facing. Okay, so IVOL has an impact on option prices, and the movements in the underlying also have an impact on option prices. Okay, so this part is captured by the delta and the gamma, and this part is captured by the Vega. So therefore, essentially you're focusing on two main drivers of option prices in this project. One is you're looking at changes in the moneyness of options. Remember, ATM, OTM, and that's another way of stating that is basically you're looking at changes, because once you fix the strike price, you're looking at changes in the underlying. Yeah, this is one of your underlying tickers, GDX. Okay, you're looking at changes in the underlying, and changes in the value of the underlying asset. Obviously, if you were long calls when the market was here at $20, if you went long calls, the market now is $22. Obviously, you're making money because the intrinsic value of your option is much higher. Okay, so the total value of the option is much higher, assuming no change in time value. So this is one thing. You are your option price. You're buying and selling options, both calls and puts, and option prices are sensitive mainly as far as you're concerned in this project. They are responding to changes in the underlying asset prices, and they're also responding to changes in the vol. Okay, and that is the changes in the I vol. Essentially, the markets, what you have to understand is the option market essentially separately keeps an eye on I vol, although market prices keep changing as an interaction, as a function of the interaction between demand and supply. We essentially plot I vol charts and try to track how I vol is changing. So as the market price changes with nothing else changing, the level of vol that is required as option prices rise with ceteris paribus, you will have to change the vol input in order to make the fair value from the option price model, option valuation model, equal the market price. So that's why you would have to change the I vol. So as option prices rise, I vol is also rising. So the market keeps track of I vol using charts like this. As you can see here, this is a chart of Oracle I vol, and it is showing, we'll make it really big, Oracle I vol, you can see here. All right, so the IV index is the I vol index. So this is the kind of like the orange line. So you can see so essentially what does this mean? You will get I vol charts, and when you see the I vol chart going down, what it essentially means is I vol is now to be taken as a proxy for option prices in general. So when you see I vol dropping, you will say that that option prices in general are falling, both calls and puts. When I vol is rising, you will say that option prices in general are rising. Then you see it falls again, and then there is a long rising trend. Again, it has started falling. Okay, as you can see, the I vol, the index here is in percentage terms because all the I vols are given to you in percentage terms. Okay, so this is the first thing you have to learn, to read I vol charts, and charts will go basically up and down. If the I vol chart is going down, that means options are becoming less expensive, and as I vol charts are going up, options are becoming more expensive, both calls and puts. Okay, so what are we going to do now here? What is our framework? So your option prices are affected by movements in the underlying asset price and changes in I vol. Obviously, they're also affected by certain other inputs, which you saw in the OVM. You see there are some other inputs, but we are just going to ignore them for the time being. We are mainly focused on the vol and the underlying price, how the option price is responding to changes in the underlying price and the vol, and that's the game that you're going to play. So what you're going to do is so these are the impacts. So, and the impact of these two factors, one can go in your favor, the other can go against you, and depending on the magnitude of the positive or negative impact, one can actually offset more than offset the other. So you have to be aware of this. Okay, so here we come to the most important thing. Before we come to that, let's look at quickly the option positions, okay, and market. So what are the two types of, we have to be clear about this. What are the two types of positions, or let's see, what are the two types of options? You have calls and puts, okay, and in general, which you learned much earlier when you covered markets, asset classes, markets, and instruments. What are the two types of positions? Long and short. So when you combine these two, the types of options and the types of positions, you end up with 4 types of option positions: long calls, short calls, long puts, short puts. Okay, so these are your 4 types of option positions. Okay, now we come to this matrix. Now we've already given you we're going to draw this, we're going to show you the matrix. It's in your spreadsheet file. Now we are going to come to a decision matrix. Okay, the broad decision matrix. How are you going to take a view? What are you going to do? Let's take an example first where you okay, let's say we are dealing with a GDX. Okay, so I'll give you, these charts are already there in your notes, right at the top. You'll see the hyperlinks. I've given you a hyperlink for short stock charts. If you click that, you'll get GDX. If you want to put in some other ticker which you have in your option project, just enter some other ticker here. If you want Oracle, just put Oracle here, and the chart will change to Oracle. Okay, and so on and so forth for all your tickers. I'm just going to show you the trick for GDX, and then we can move forward. Okay, so this is how I'm going to give you a model of how you're going to trade. You look at the GDX, you figure out what you want to be. Let's say you have to figure out, let's say, look at, I'm going to use TA, and you have to form a view essentially. Okay, and let's say in this market, my view is, I look at the chart and I see the trends, and I say that, okay, my view is bullish on the underlying asset. I'm bullish. Okay, so I register that I'm bullish. Now, but this is not sufficient because I'm going to be trading options. So I also have to have a view on the I-vol for GDX options. GDX is the underlying, okay, it's the ETF gold miners, gold mining stocks. But this is just the underlying asset. Because I'm trading options, I also have to have a view on the I-vol. This is the new part that you're learning. In order to trade options, you need to have a view not just on the underlying asset, which you're familiar with so far, but now you have to have an additional view on the I-vol. So we find a I-vol chart for GDX, which is here. Okay, there is a index already for that. Okay, so if you see this one, this is actually, is this a 5-year chart? Yeah, I think this is a 5-year chart with the same time frame. I take this 5-year chart, I form a view which is bullish on the underlying asset. Okay, and then I use this chart. Now this in real life might be a little bit problematic. In some cases you may not get the chart, but we are going to assume we are learning the theory at this stage, and I think for most of the tickers you'll at least get 1 year of data for I-vol. You get 1 year I-vol charts. Okay, so I form my view on the underlying asset. Now this is the I-vol chart. This is the chart for the I-vol of GDX, okay, of options on GDX. So what this is, how do they construct this chart? They keep looking at option prices, both calls and puts on GDX. Okay, and by looking at those option prices, they figure out what is the I-vol that is necessary as an input into the OVM in order to produce those same option prices, and then they register that. This is just time series data. They plot that. Okay, and that's how the I-vol chart is developed. So essentially what this gives you is, it gives you a broad idea about how the cost of options on GDX has been moving. Okay, at this point obviously it was very high. Okay, in 2011 it was very high, then it has started falling, then it goes up from time to time. So this is basically an index. An I-vol chart essentially tells you how expensive options are, okay, or how cheap or how expensive options are. At this stage you can see essentially that option prices on the GDX are at their lowest level, probably the lowest level, and there may be some minor differences here, but pretty much close to their lowest level since the data series started, which means in almost 8 years, 9 years, these are the lowest levels of option prices in general for options on GDX. Okay, so if you're a mean reversion type of guy, this kind of thing probably is going to make you bullish on options. Okay, because you see this keeps going down, then obviously as a mean reversion guy, you expect this to turn around and jump up and start going back to the mean. So let's say I'm a mean reversion guy when I form my view on IVOL. So my underlying view on GDX was bullish, and my underlying view on IVOL is also bullish. Okay, so what do I do now? I've got the two views, the two important things I have to have views on. Now I go to my matrix. Remember that when IVOL goes down, that means options are becoming cheaper in general, and the reverse. And this is, you already know the views on the other line. Let's go to your calc file. In the option sheet, I think this is in the option sheet. Yeah, it's in the option sheet. All right. Here's a little framework that I've made for you guys. Okay. This is not very pretty, of course, but this is how it's meant to be seen. This is the framework overall. This is where it is. Okay. So since we know that when IVOL goes up, when IVOL goes up, options in general become more expensive. Okay. And when IVOL goes down, options in general are becoming less expensive. Underlying asset, obviously we can have a bullish view or a bearish view. So what did you see? Let's take the example that I started with. Okay, what was my view? My view on the underlying asset was bullish, and my view on IVOL was also bullish. Okay, so therefore what is my decision? It's to buy a call. So this is your decision matrix. You got to get familiar with this matrix, but see how it makes sense. So because what we said, IVOL, if you're bullish on IVOL, means you expect option prices in general to go up. So in this column, in this bullish column, you're only going to be buying options. Could be calls, could be puts, but you're going to be only buying options. When your view on IVOL is bearish, you're only going to be selling options. So sell, sell. Now in this box, let's take this. You're going to be buying, but what should you buy, call or put? But if you are bullish on the underlying asset and you have to buy an option, will you buy a put or you'll buy a call? Are you going to buy a call? You will buy a call because that's the one that benefits when the underlying asset actually goes upwards, right? And similarly, you'll buy a put when the underlying asset view is bearish, because puts are what benefit when stock prices, when underlying asset prices fall. So using this logic, you familiarize yourself with this matrix. So this is, you already have your decision framework, and I'll just give you a little bit more of a set of rules. Okay, so you already have your logic is like this. Take each ticker in your option trading project, form a view on the underlying. I took the example of GDX. I formed a view on the GDX. I looked at the IVOL chart I looked at the IVOL chart of, where is that chart gone? Here. IVOL chart of the GDX options, and I formed a view on the IVOL for GDX, and that was bullish as well. Then I came to this, that brought me to the framework, and I decided that my decision is to buy a call. So now we have some clarity between all these options. I have zeroed in on buy call. That's my strategy. We have a couple of more decisions to take, which is, remember that in the case of options, we have some other decision problems, additional decision problems. Okay, because we have to, I'm going to rush through with this a little bit. Okay, so all this logic is explained over here. This is just nothing but the explanation of that matrix. Okay, so you have some additional problems when you have to buy options. You have to decide the expiry date, because there are many expiry dates. You have to decide which strike to choose. Okay, that's another option that you have to choose. And the exercise style is not to be chosen, and you don't have a decision here because these are all American style options. US equity options are all American style, so you don't have to make this decision. So how do you decide the expiry date and the which strike rate to choose and which expiry date to choose. So here I've given you some additional guidance. Okay, just go through that. Essentially, you can see there is some guidance given to you here. You can. So one of the things you want to look at is for the strikes that you look at, you'll find that the option, the IVOL structure is not the same. The term structure of IVOL there is also a term structure, and there's also a variation in IVOL. When you look at the TWS option trader and you mouse over the prices, you'll find that the term structure of IVOL is the IVOLs actually vary across strikes. Okay, when you mouse over the option premium, you'll find that the percentage figures that are shown, those are the IVOL figures. Okay, so in general, what you're going to do is we're going to go through this a little bit. I think it's here. Okay, in general, when you're selling options, you try to sell short dated options because there the theta is much higher. And when you're buying options, you try to buy longer dated options because they have less theta and they have more Vega. So you have a double benefit. Okay, so this is one way to solve this problem, because you have an additional decision problem. Should I buy or sell a short-term or a long-term option? What should be the expiration date? Push yourself towards longer dates if you're buying and towards shorter dates if you're selling. And as far as the strike is concerned, try to look at strikes which have higher vol. If you're selling, you want to sell. So remember that this is actually an index of this chart that you have, the IVOL chart. That's an index of option premium. Okay, so in general, when the IVOL is high, the option is more expensive, so you try to sell more expensive options. So you try to find along the strikes, you try to find those options which have higher IVOL. Okay, and there is a balance of that you have to strike with the sensitivity of Vega. You can see. Okay, the ATM options have the highest Vega. Okay, generally out of the only options have lower Vega. But the other thing is also that absolute higher levels of volatility are a better sell. Okay, so that's what you would try to do. Alright, so we'll end this tutorial here. So you start your live trading from Monday, and we'll continue with the discussions later on.